Baidu. Its stock's down 50% in the last year. So the question must be asked, what's going on with this company? Why are they down so much? And where can this company go in the future? Well, that's what we're going to talk about today. So let's get into this. To be honest, there are many reasons for Baidu's recent sell-off. But some of the biggest reasons are that China's economic growth and its currency are weakening, China's regulations, Baidu's growing competition, and iQIYI, the company that they own 58% of. All four of these create some degree of risk. But are they really that big of a deal, or is Wall Street overreacting? Well, let's look at each one. It's known that China's economic growth and its currency are weakening as trade tensions rise. In recent reports, we saw that China's economic growth has slumped, and a weakening of their currency has been a factor in the decline of this stock, as most of their cash and revenue are denominated in the yuan. But this con alone shouldn't have the power to pull this stock down so much, as the company is not directly impacted by trade. And although China's economy is slowing, it's still expected to continue growing, and more people are expected to have access to the internet in coming years. So what about China's regulations? How big of a threat are they? Well, it's true that China's regulations of internet search have slowed down Baidu. See, it's known that China has increased its grip on the information and practices of internet companies. And Baidu, being in China, obviously complied to China's rules. But it has slowed down their innovation and growth. Baidu's main virtue lies in its ability to connect Chinese language speakers through its AI-powered search engine. But China's constant censorship and regulation can be annoying. However, are these really that big of a deal? Well, yes and no. See, China's rules and regulations make it very difficult for foreign companies like Google to comply. So, the rules and regulations actually lower competition for local companies like Baidu. But they also require local companies like Baidu to put up money, time, and resources into regulation, monetization, and complying to the CCP, money that could be better spent elsewhere. But at the end of the day, China's regulations haven't stopped Baidu from growing. They've simply slowed down their potential growth. And it's important to remember that there's a lot of people in China that don't yet have internet access. So as more of China gets access to the internet, corporate online advertisement spending is expected to increase. So although China's regulations are a pro and a con, the largest concerns seem to be Baidu's growing competition and somewhat how they're working with their company iQIYI. As companies in China become more and more attracted to online advertising, advertisement companies find themselves fighting for customers. See, Baidu is finding itself in the middle of a huge fight between itself, Tencent, and Alibaba. As these companies improve their advertisement platforms, companies in China now have the option of spending their money on more advertisement platforms, creating more competition. In addition, companies like Tencent and Alibaba have more cash and are willing to lose money in order to take market share. But just thinking about that, is that really a big risk, or is Wall Street again overreacting? Well, you must remember that even though most of Baidu's money comes from advertisement and they have competition, the entire online advertisement market in China is expected to expand. So yes, their share of the overall market may drop, but that's okay, because the pie is getting bigger, and it's getting bigger fast. Even if the trade war continues to slow down China's economy, they are still expected to post positive growth numbers for years to come, barring any massive global recession. And lastly, we have iQIYI. This is one risk that investors should be paying attention to. See, iQIYI is now a public company that Baidu spun off last year. It's considered to be the Netflix of China, with more than 100 million paying subscribers and almost 1 billion monthly active users. So yeah, they're pretty big. Plus, Baidu still owns 58% of iQIYI. The biggest problem with iQIYI is that they're losing hundreds of millions of dollars every year, and Baidu's been propping them up. The question in investors' minds is, when will iQIYI become profitable? And how much will Baidu be willing to spend to continue propping this company up? Yes, iQIYI is growing its revenue crazy fast, but it's also losing money really fast too. Recently, Baidu's been propping this company up, and that's simply dragging down Baidu's overall valuation. But at the end of the day, Baidu can afford to do this, as their core is still very profitable. It kind of looks like Baidu's taking on the Amazon approach, by using earnings from one business in order to grow another business. So after looking over all of this, I feel like analysts on Wall Street are so focused on the negative that they can't see the gold mine that Baidu is sitting on. Let me explain. Over the years, Baidu has transformed its company from a search-only business to an artificial intelligence and advertisement company with a number of diversified businesses, including Apollo, Baidu ABC Cloud and AI Solutions, and a 19% stake in Ctrip. We saw that the iQIYI spinoff unlocked great value. If Baidu were to spin off businesses like Apollo or its Alibaba ABC Cloud platform, that alone could unlock even more future value. Looking at Baidu's valuation, we see that this company is valued at $41 billion. But their balance sheet contains assets of great value. If we subtract Baidu's total shareholder equity of about $24 billion from its market capitalization, we get $17 billion. Therefore, outside of Baidu's shareholder equity, the company is only being valued at 6 times earnings, which is crazy low for a tech company that has a solid balance sheet, very little debt, is growing their revenue at 20% annually, even with the losses from iQIYI. In conclusion, the value of Baidu significantly exceeds its current market capitalization of $41 billion, if we remember that this company has $24 billion in shareholder equity. I'm actually quite shocked to see how low this company is valued. I don't see competition, regulation, or a global slowdown being a major threat to this company, assuming we don't have a huge recession. The biggest question I have is, will iQIYI become profitable? I think Baidu's taking on the Amazon approach, using earnings from one company in order to fund another one. If we were to give Baidu's earnings a very conservative valuation of just 12 times, and then add the additional shareholders' equity, the company will be valued at around $61 billion. That's about a 50% upside, and that's really lowballing it. I truly consider this company to be one of the safest long-term plays on the Chinese growing internet sector for the next 2 to 5 years, if trade tensions continue. This company simply looks way too undervalued when we think about the assets that they're holding on to and the valuation that's being given to their earnings. No matter what happens, I think this company is going to be okay. I don't see much hardship for them in the future, mainly because the stock has been pushed down so low, there's not much more room for the stock to fall. I feel like Wall Street's overreacting to the news, and I don't see much more room for this company to fall, but I see a lot of potential upside. So let me know your thoughts in the comments section below, and subscribe if you haven't already. And remember, I'm not telling you to buy, sell, or hold anything. These are just my thoughts on this company, and any financial decisions you make are between you and your financial advisor. I'll see you next time. Peace.